Investing in the restaurant business can be very hit or miss, especially with the current levels of inflation and cost pressures most businesses in the sector are currently facing, which is the reason why, despite having 22% of the market share, Domino's is down about 42% this year. However, while the stock may be down big, this may actually be the value investing opportunity that you've been waiting for, and I'll tell you why as long as you stick around to find out, as we'll be talking about all that and more on today's episode. How's it going? Welcome to Everything Investing. I hope you're having a great day. Today we're going to analyze Domino's Pizza's business and earnings results. We'll do a full analysis into the financials. We'll go through the top line, the bottom line, the balance sheet, the cash flows, etc. And finally, we'll conclude with an evaluation of this business using our intrinsic value calculator seen on screen, which will identify whether or not Domino's is a value investment or not. And if you enjoy the analysis and the value investing perspective, please like and consider subscribing for more of this content. As always, we will be doing this business analysis in 5 minutes, so let's jump into it. So as always, we will start with the CEO's comments. Just as an FYI, this is the largest pizza company in the world by their definition, which did grow by another 225 stores this quarter. But with that being said, let's jump into the comments. And basically, management says that they are encouraged with their performance so far and with the improvements that they've made during the third quarter. Their team members showed the perseverance required to operate in this volatile macroeconomic environment, and that once these volatile times are over, they should emerge stronger than ever. Additionally, they also did mention that they delivered about 1 out of every 3 pizzas in the US prior to 2020, and they still do that today. And that's why, in conjunction with all their business segments, they have never been more confident on the future of Domino's than they are today. Now let's quickly jump into the first statement, which is the statement of income here, and we'll start with our total revenue figure of $1 billion for the quarter. You can see how their revenues are broken down here, with supply chain being the biggest contributor to their revenues. Then we have our cost of sales. We deduct our cost of sales of $686 million, so we're left with $381 million in gross profit. Deduct our other SG&A expenses and such, and we're left with $176 million in profit from operations. All right, deduct some more taxes and whatnot, turn this into a per share value, and we're left with $2.80 in net income per share. Keep this in mind when we get to the end of the video, as we will be using this for our calculation. But if we look at this from an operating income perspective over a historical time horizon since 2010, actually, we can see they have been able to produce an 11.8% CAGR over this time period. So this is great to see from a potential business investment. Now, in terms of the balance sheet, we have about $115 million in cash. We also have $184 million in restricted cash, which is restricted, but we will add them together for the sake of our calculations here. We'll say we have about $300 million in cash on the balance sheet. And when we compare that to their debt figures, they have about $55 million worth of current portion of long-term debt, plus another $5 billion worth of long-term debt, giving us about $5.1 billion of debt on that $300 million in cash. As you can see, historically, for the most part, their cash position has been rising year over year, but so has their debt. And actually, if we look at their leverage ratio here, we can see their target ratio is about 3. However, they're currently trading at about 5.6, so they're way off. Now, towards 2014, they were working towards that target leverage range, but since then, they have had to take on more debt and they've had less cash on hand, and that's why their leverage ratio is about 2 times where they actually want it. So keep that in mind when we get to the end of the video. Now onto the free cash flow. As you can see here, they produced about $330 million in operating cash flow, deduct about $50 million in capex, and we're left with $280 million in free cash flow to reward shareholders. What exactly do they do to reward shareholders? Well, they're effectively using pretty much all of their free cash flow right away by purchasing shares, then taking on some debt, and then rewarding shareholders with what I like to call a debt-induced dividend, which is a big red flag and a big no-no for me personally. However, if you look at their total shareholder return over the last 10 years, they have returned about $6.3 billion worth to shareholders. This is a business with an $11 billion market cap, so that is quite a substantial return on your investment. And as you can see here, it is outperforming the market in terms of shareholder returns. Now, with all that being said, before we jump into our calculator, let's take a quick look at what analysts expect for Domino's Pizza by the end of 2022. As you can see, they're looking at about $12.19 to $12.79 in earnings per share by the end of the year. For the first 9 months, they were able to produce about $8.11 per share. So if we assume that they'll have a nice strong Q4 and they can produce about $12 in earnings per share by the end of the year, and if we require a 10% return, they do pay a dividend. And if we do expect that once the cost pressures diminish, they are able to get back to that 5-year EPS growth metrics of 25% for the first 5 years. And then after that, that drops down to, let's call it 15% on a 20 PE, the stock would be worth about $765 per share. That's a pretty large number considering they're trading at about $317 per share currently. Now, in the most optimistic point of view, let's assume that they can grow at 25% for the next 10 years on a 25 PE like they're kind of currently trading at. Yeah, this stock would be worth 1.2 grand. I think this is a little too over optimistic here. Let's look at our worst case scenario here as a more realistic point of view, and let's assume that with their 10 to 12% CAGRs across the board, fundamentally they can maintain that as well with their earnings per share metrics for the first 5 years at least, and let's assume that drops down to about 7% for the 5 to 10 years after that. On a 15 PE, the stock should be worth about $277 per share for a margin of safety investment. Now, it's not too far off of where we are currently, and the stock has dropped about 42% this year alone. So we can probably get down to those levels. And if we expect that PE ratio is actually going to stay around 20 instead of going down to 15, yeah, we're actually sitting at about a margin of safety investment here for Domino's Pizza, considering they do actually pay a dividend. They are rewarding shareholders. They have a free cash flow yield of about 4%. You know, they're also the #1 pizza business in the world. I mean, there's a lot of good things going for them. The unfortunate part here for Domino's Pizza is simply the debt, with $5.1 billion of debt on the $11.4 billion market cap. That is way too much debt for me. They're way too over-levered. They know that they're over-levered as well, as they're at double the leverage ratio that they currently want. And it's the reason why I'm staying hands off of Domino's Pizza, at least for the time being, as I'd like to see this stock actually move down closer to where it was back in 2019, 2020, around 250, let's say, dollars per share. Until then, or until anything else changes, I'm staying hands off. But that is the analysis for today's video. If you made it this far, please leave a like and subscribe, and I'll catch you on the next one.